Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday once again. And, between Fridays and Monday is when bulk of the price action nowadays happens. And we've spent many weeks now walking back what happens during these 3 days. So we'll see if this is a repeat once again or not. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Morning.
Hi, morning.
Hi, morning. Crude once again is higher, and we've got a lot of earnings to react to. But finally, guys, it's a Friday.
Well, that's right. But the global market's a little bit iffy, a bit of risk off. So let's see how it goes on Friday, and then we head into the weekend.
The weekend though is nowadays news-wise action-packed, you can look at it one way or the other, say that there's no price discovery. So you can just come back on Monday morning and just deal with whatever it is, right?
Sometimes you come back on a Sunday morning.
Sometimes you get back, and that's the problem. And that's the reason why, the weekend is not exactly the weekend. But take it from the beginning, right? So oil prices continue to climb, and just look at it where we were yesterday. Look at prices where we are now. So we're about $4-5 higher, and yesterday was high enough, 102. We're at 106 now, 106, 107. It's not good, absolutely. As I said, we are, of course, importing 5 million barrels of oil a day, and you're paying a lot more as compared to what you were paying earlier. By the way, the difference between, so what we track is paper prices, financial asset prices. But, there are reports that crude for delivery in Asia, physical prices are, north of $160. So it's starting to climb once again. And if you remember, beginning of the week, late last week, we were talking about how, even though the situation, lesser oil is going through the Strait of Hormuz with the US blockade now, physical oil prices had come off from highs of 140, 145 to 110, 120. And whether that was sustainable. I think it's moved back. It's moved right back across the board. And we'll talk more about this as we go on. In terms of news flow, there's not very much. US forces boarded vessels as the Strait of Hormuz blockade continued. Trump ordered the US Navy to shoot and kill any boat placing mines in the strait. I guess this has already been done in that sense earlier. And of course, Trump also announcing Israel and Lebanon will extend their ceasefire by 3 weeks. But the main issue here is, of course, Iran. Trump also shot off a Truth Social post yesterday evening, essentially saying that, Iran is trying to figure out who the real leader is. So we need a figurehead to negotiate with who can prevail upon all the other parties in Iran. The fear, of course, is with the civilian government out of the picture now, hardliners are basically in full control. That is the IRGC. And this then becomes more complicated than before. Now, US equities, they closed lower, but off the intraday lows, they were down more. S&P down 0.4. The Nasdaq was down about 0.8, 0.9%. And technology stocks, both large, small, all kinds, basically sold off. Salesforce was down 9, IBM was down 8, Microsoft was down about 4% or so. And by the way, there were results from two companies, ServiceNow and IBM. And you look at the numbers per se, especially ServiceNow, numbers are not bad. Markets just, the guidance perhaps was a little bit of a miss compared to what the market expected. But generally, fears that some of the longer-term fears coming to dominate the narrative right now, that AI disruption, all of that stuff, it's almost deja vu. Look at the rest of the software names, right? And this is what Indian investors investing in Indian IT services also keep a close eye on. So Globant was down 9, EPAM was down 6.5, Accenture was down 6. Cognizant was down 6. Infosys, of course, reported numbers here in India yesterday evening. That was down 4%, and the Wipro ADR was down about 4% as well. So that's the situation. In terms of other news flow, Trump repeated his criticism of Powell, praised the incoming Fed chief, Kevin Warsh, and there's not very much new. And I'll just leave you with the levels here. Supports are 24,100, 23,900, and then 23,500. We broke 24,300 yesterday. We closed under it, but 24,100, very, very near term, 24,100 and then 23,900 are supports which markets will watch out for. As I said, today is a Friday. Go back and see what has happened the past many Fridays. You know, in the evening, you get some tweet, something from President Trump, and the markets jump, react one way or the other. Over the weekend, that reverses. And then the next week is basically spent walking back whatever happened Friday evening. So it's complicated. It's tricky, especially because it is Friday and then you're heading into a weekend when markets are shut. And the only way to react to any of it is Monday morning in that sense. We'll talk a little bit about the political stuff as well. Remember, polling in West Bengal, etc., very high turnouts. What does that mean for chances for the BJP, which the market, of course, would like very much for it to come to power in Bengal? Is that, I mean, we can talk more about that. But 90 points higher on the GIFT Nifty is what the indicative opening is at. Well, Nigel is walked across to the wall, F&O positioning and the data. Nigel, over to you.
Well, the gap up could get sold into, I think, because the global cues are a little bit tricky, and then we'll take the path from there if in case we do start off 90 to around 100 points higher, because the geopolitical tensions continue to weigh the dollar index. That's stronger overnight. Brent crude prices as well have spiked up to around $106 per barrel odd mark. So both those two, they are actually indicating a bit of a risk off. In terms of flows, the DI is bought, but they bought only around 1,000 crores approximately. The FI as well, they were sellers in yesterday's trading session. We did see that the FI as well, they sold close to around 3,300 crores or thereabouts. But looking at the Indian rupee then, yesterday we did see there was some kind of weakness out there. And after pulling back to around 92.5 odd, we are seeing some weakness on the Indian rupee. The Indian rupee, in fact, went to around that 94 odd mark. The FIs in the futures market, they've added shorts yet again. On the index, there were 5,000 contracts that were added on the short side. And on the stocks as well, there were close to 29,000 contracts that were added on the short side. And there was long unwinding both on the index as well as stock futures. The short point is, in a bit of a wobbly market, the shorts are piling back on. On the index, the FIs continue to remain net short with close to 79% of the positions on the short side. Moving to the positioning of the last few days, well, you can clearly see the FI short positions as the markets have come off from around the 24,500 odd mark. They've added close to around 16,000 contracts on the short side. While the clients, well, they had unwound some positions from a peak of around 170, 180,000 contracts on the long side. It had come down to around 1 lakh contracts, and gradually the last few days, they have in fact gone ahead and added some of those long positions as well. There appears there's a strategy in place because we have the monthly expiry that plays out on Tuesday, the 24,200 call as well as put. Both of them were fairly active, and there appears there's a short straddle at play. That is, you're writing both those two strikes and you're pocketing close to around 400 rupees. And if you're looking at that particular, strategy, then you have a broad range that comes up for you on the screen. So 400 points on either which way, 23,800 and 24,600 or thereabouts. The Nifty Bank, that's breached the 20 as well as the 50 DMA, on the Nifty Bank. But for the Nifty, these are the important levels. On the Nifty, the 20 DMA, that's the important reference point that you're looking at on the downside. While on the upside, the 24,320, which incidentally is the recent high as well. Yesterday as well, we almost went to that mark. That becomes a resistance mark. The Nifty Bank trading below the 50 as well as the 200 DMA. So that's the resistance zone out there. And Reliance Industries, towards the end of trade, we'll keep an eye out on that because that could swing the Nifty since it runs into its numbers post-market as. So that big boy on your radar as well.
Thank you very much for that. But some concerning news. A lot of brokerages have started downgrading India. And the pace has picked up in the last couple of days. So today, it's JP Morgan downgraded India equities to neutral. It's Rajiv Batra who says they've downgraded Indian equities to neutral. The structural story of India is intact, but tactical headwinds warrant patience. He says the key drivers of the downgrade are 1. A valuation gap narrowing, but still stretched. 2. Earnings risk. 3. Dilution caps upside. 4. Limited next-gen tech exposure. And 5. The monsoon risk. Overall, he says they see better opportunities elsewhere in the emerging markets until the valuations derate further or earnings visibility improves. But back to the big story then about US and Iran. US President Donald Trump said that he is under no pressure to end his war with Iran, though the time is limited for Tehran. He wrote on social media, "I have all the time in the world, but Iran doesn't. The clock is ticking." However, speaking to reporters when asked how long he would wait for Iran's response to get a deal, this is what he had to say.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff.
Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. We're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you.
Okay, Mark Matthews of Bank Julius Baer & Co. joining in. Mark, thank you very much for joining in. Crude prices on the boil now 106, and it's hurting India, and brokerages are quickly downgrading India. It's not just JP Morgan. Yesterday, we spoke about HSBC. Prior, it was Nomura, it was Goldman Sachs, it was UBS, all sounding a bit cautious and saying the opportunities are better elsewhere in emerging markets. You've been a bull on India. Is that thesis changing?
I see the points that they're making, and they're valid, but I think you can come back with counter arguments. One very simple one is that the oil price will not stay at this high level if the Iranians and the Americans come to some agreement, and that is our base case. They're playing chicken with each other. Both can play a waiting game, but I think that Iran is the more vulnerable one because their budget is $56 billion a year. The American budget is $6 trillion a year, and Iran is losing about $400 million a day because of the blockade. So I think as much as Trump has the midterms to worry about and the high gasoline price in the United States, the Iranians have reason to come to the table, too. The major point of contention, of course, is nuclear power, and it's so deeply embedded in the Iranian psyche now that I don't know how they can get around that. But where there's a will, there's a way. So if the oil price does come down, and we do expect it to be back in the 60s by the end of this year, I would think intuitively the markets that have performed the worst since this war started would recover the most, and India is right at the top of that list. The other thing I would point out, just a technical thing, is the very strong rebound in the mid-caps. The nifty mid-caps are just about 2% below where they were before this war started, and I think they're acting as a lead indicator for the nifty itself, and so I believe that the mid-caps will make a new high, and then the nifty will follow suit.
Mark, you would be an outlier in expecting crude prices to go back to where they were before the war started, back to levels of $60 per barrel by the end of the year. But markets are a game of probability. Assuming that oil prices settle higher, maybe around $80, $90, $95 per barrel, then how would India be placed?
Just to clarify, I didn't say $60 a barrel, I said in the 60s. So to be precise, our price is 67 by the end of the year. I think oil above 80 is a problem for India. So I think the economy can survive, but I think it's a price at which investors would just stay away because they would look at it as being, too high. I think India can manage economically up until 90, maybe even 95, because the infrastructure has improved so much and the machinery and the equipment in the country compared to, say, 20 years ago. But $80 a barrel would be broadly where I think the price point is, where people would, until we get below that, I think people will just stay clear of India.
Mark, we've got to talk about software as well, and we'll do that in just a bit. But just one more question, right? Do you believe that the so-called off-ramp... Look, markets are optimistic by nature, right? That things will get resolved. How can this go on? This is illogical because markets' collective wisdom is... they're based on logic and, the greater good and good stuff happening. But just look at last 12 hours or so. Do you believe some of these off-ramps are, in a way, fading, disappearing? All the statements, President Trump's posts, and the press conference by Hegseth and Kane. The one thing market's not ready for is re-escalation of actual, fighting, bombing or whatever, right? You think that is a risk at all, or no?
I think the oil price is partially factoring that in. It's, as you know, Brent is well above 100 again. All I can say is that it is in the interest of both sides to diffuse this confrontation. And of course, they're both putting up a lot of bluster. It's like when you're buying a carpet in a carpet store. Of course, the merchant is going to start with a very high price, and you start with a very low price, and you meet somewhere in the middle. But what I would also say, if you look back at the history of these oil price shocks related to geopolitical conflicts, there's been about a dozen over the last 30, 40 years. And the trajectory is always the same, that the oil price goes up quite steeply about a month or two, and then it comes back down. And that goes back really to the first Gulf War in 1990. It's always the same thing. I think in part because, apart from the fact that the political issue tends to get solved, also when oil is at the kind of prices it's at today, all kinds of marginal producers are profitable, from Canada to Brazil and shale in America, and they'll produce more. You have to go back to the 1970s, specifically 1973 and 1979, to see oil price shock that ends up lasting for years. And I don't think we're looking at one of those.
All right. Hi, Mark. Very quickly, I wanted to ask you about Google announcing the big capex plan, agentic platform, overnight. They're talking about $170 to $180 billion. How worried are you about all these large capex that have been announced in the last few months, and overnight as well, the one that we heard?
Yeah, clearly the capex of the hyperscalers has been the reason why those shares have not outperformed over the last half year or so. Previously, the big tech stocks in America were these massive outperformers. And I would say that the forecast for the hyperscalers in general, not Google specifically, but the hyperscalers in general, is that their capex will peak in the second half of this year. And if that's the case and they start implementing AI in the workforce, unfortunately, that may come at the cost of a lot of people's jobs. You might have seen the report a couple of days ago from Meta that they're going to fire 10% of their workforce. Anyway, I think that what we will also see very soon is the direct impact of AI in these companies' P&L statements that will be very, very accretive and cause a return on investment. So I think the market is already starting to see that, and it's starting to come back to liking the technology sector again.
All right, Mark, thank you very much for joining us. Good speaking with you, and it's a pleasure having you here on CNBC-TV18 as always. Let me just quickly run you through the interactions which are lined up in the program. 8:35, we've got the management of Aequs joining us in just a bit. So we talk about the company's business outlook, F527 roadmap. 9 o'clock, Bhavin Shah of Sameeksha joins us on Infosys and other software companies. Gautam Shah of Goldilocks Research will be your market master of the day. 9:30, we have Birla of Aditya Birla Sun Life AMC to talk about the fourth quarter numbers. Management of Himadri Specialty Chemicals will be speaking with us at 9:40 on their earnings towards the end of the program. Lata discusses with PIMCO's representative on where oil prices are headed as the war drags on. Stay tuned.
Time to slip into a short break, but we've got a lot of stock-specific action to track for you. We'll get to that in just a bit. For the time being, I give you a sneak peek into the list. Tata Capital, Himadri Specialty, IKS Health, Bluestone Jewelry, Mahindra Logistics, all of them will be reacting to positive news flow. While on the flip side, Infosys, Iant, GMR Airports, they'll be reacting to negative news flow. While you'll have, LTI Mindtree and United Breweries that could open up next.
Welcome back. You're watching Bazaar Morning Call. It's a Friday morning. It's time to talk about stocks. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. Hi, guys. Good morning. But let me begin this one with Infosys, which reported their numbers. The ADR was down 4%. The stock, by the way, in the last 5 years has given no return now. In fact, in the last 5 years, stock is down nearly 7.5%. Missed the mark on revenues and margins. Revenues declined by 1.3%. EBIT margin expansion of 20 basis points was less than what the street was anticipating. And the deal wins cooled off compared to what we had seen in the last couple of quarters. FY27 guidance at 1.5 to 3.5% top line growth. Margins at 20 to 22%, in line with estimates, but no positive surprise. Jefferies says they've got a hold call. The dividend yield limits the downside, but weak growth caps the upside. Citi has a neutral call. They've cut EPS estimates by 1 to 2%, but they still expect the company to outperform peers. Nomura, though, has a buy call, and their target price stands at 1640. So disappointing numbers, but remember the stock has fallen 5.5% just in the last 2 days after HCL Tech reported the numbers. So how much of this is already in the price?
All right, got that, Rima. Thanks a lot for that. So disappointing numbers, as Rima said, but the stock has seen some kind of pre-positioning as well. Hopping across to Ananya, though, she's here to tell us about Tata Capital's numbers. Morning, Ananya.
Tata Capital has ended FY26 on a strong note. Let us look at the AUM growth. So AUM grew 20% YOY and 6% quarter-on-quarter, excluding Motor Finance. The core franchise looked even stronger with AUM growth of 28% YOY. Now, profitability was very impressive. PAT rising 43% YOY. Excluding Motor Finance, PAT growth was even stronger at 51% YOY. Now, asset quality trends were clearly encouraging. Credit costs improved to 0.9% from 1.2% in the previous quarter, while gross stage 3 improved to 2% from 2.2%, and net stage 3 improved to 0.9% from 1% in core book. Now, management highlighted that slippages are now at their lowest in the last 8 quarters. Now, on the business mix, retail and SMA continue to anchor the book with at around 86%, while unsecured retail stand at 10.3%, giving the room to the company to expand the segment more, which was also highlighted by the management. And most importantly, Motor Finance is now stabilizing, showing early signs of recovery, and management expects growth momentum to pick up by FY27. They expect ROA at 2% by FY28 for Motor Finance. Now, most importantly, management commentary remained quite constructive. They guided for 23 to 25% AUM growth in FY27, expects cost of funds to be lower than FY26, better margins with better product mix, and expect credit costs to normalize around 1%. So overall, this was a very strong quarter for Tata Capital. They are now focusing on growth, profitability, and AI-led initiatives.
Thank you very much for that, Ananya. LTI Mindtree also, it's an okay set of numbers. Again, no beat, maybe slight downside to consensus expectations. The company's top line growth, 1.2%. EBIT margins at 15.1%, lower by 100 basis points on account of the partial wage hikes implemented 1st of January and productivity commitments in key accounts, partially offset by the forex benefit. But in the conference call, while the company didn't give out a specific guidance, they did say that they're aspiring for industry-leading growth in FY27, and they're looking at doubling their revenues in the next 5 years as a part of their Lakshya 31 strategy, and this includes inorganic. So Q4 numbers are okay-ish, maybe slightly soft, but the guidance by the management is fairly optimistic, looking to double their revenues in the next 5 years. But it's over now to Sudarshan for United Breweries.
So Heineken, the parent company of United Breweries, yesterday reported the earnings, and in that they have commented about the India business, which continues to be led by the premium segment. So led by Kingfisher Ultra Premium segment, volume has grown by mid-teens, while in India net revenue has grown by low single digit, and total volumes have come in only in mid-single digits. So because of mixed set of earnings, I'm going with yellow for United Breweries.
Thank you. And one more IT company that's signed, and here it's a disappointing set of numbers. Now, Sign's overall revenues have fallen by 7.2% on a year-on-year basis. Now, Sign's top line consists of largely the DET business, which is digital engineering and technology, but they also have a very small contribution coming in from semiconductors. So 7.2% is the overall decline. But in that, if you look at the DET business, that too has seen a decline quarter-on-quarter and on a year-on-year basis. And brokerages have cut the EPS estimates following a poor show. Broadly, by 2 to 4% are the EPS cuts seen for Sign. So a negative performance here. But moving on now to non-IT names, Bluestone Jewelry, Mahindra Logistics. Sudarshan, how did it look?
So like all the other jewelry companies, when Bluestone Jewelry has reported a very strong set of earnings. Revenue has increased by almost 50%. Adjusted EBITDA has seen a surge of more than 240% year-on-year. And same-store sales growth too has seen an increase of more than 30%. It's 34% year-on-year. Next one, Mahindra Logistics, also a strong set of earnings for Q4 FY26, has reported a profit against loss in the same quarter last year. Profit at 20 crore versus loss of almost 7 crore. Revenue has increased by 14%. EBITDA too has seen a jump of 43%. All the major segments have seen an increase in the revenue in the range of 14 to 25%. Express business revenue up 25%. Freight forwarding revenue up 14%. And mobility business revenue has seen a jump of 22%. So I'm going with green for both these names.
All right. Thanks a lot for that, Sudarshan. Hopping across to Sonal, she's here to tell us about Himadri Specialty, whose numbers look pretty okay. Morning, Sonal.
Good morning, Nigel. With Q4 numbers were decent. Revenues are up 14% to come in at 1,288 crore rupees. EBITDA up 21% at 280 crore rupees. Margins were down 100 basis points, but profits were up 8% to come in at 208 crore rupees. However, if we look at FY26 numbers, revenues are flat. They came in at 4661 crore rupees. EBITDA was up 19%. Margins were also higher, but profits were up 36%. So yes, there was EBITDA growth, but revenues are flat. So we'll need to know whether that was because of lower realizations or lower volumes. They are a net cash company, but net cash reduced on a YOY basis to come in at 121 crore rupees. A lot of capex that they announced earlier has come on stream. So we'll have a conversation with the management today to understand what the outlook is going forward. But going with green on Himadri today.
Okay, all right. Cut that, Sonal. Going across to Vivek, though, there's a large trade, I think, in the offing. GMR Airports is the stock in focus, Vivek?
That's right. Good morning. So GMR Airports is in focus. A rejig as far as the promoter holding in the company is concerned. French company Group ADP, that held almost 30% stake in the company at the end of Q4, is going to sell up to 7.3% stake in the company. And this particular stake is going to be sold to the GMR promoter group only. Now, the first tranche of this particular deal is a 3.4% stake that will be sold at $256 million, indicating a little over 15% discount to the last closing. Other than this, they will sell an additional 3.9% stake before 30th April 2027. Again, this particular stake sale will be done at 3,100 crore or close to 285 million euros. Now, this is the equity portion of the deal. Along with that, GMR will also buy back the FCCBs with interest paid as well. Now, the key thing to watch out for is number one, source of funding as far as GMR promoters is concerned, whether there's going to be any pledge of shares or whether they are raising debt. That will be the first part. The reason why Group ADP is selling this particular stake is that they have mentioned that they will use the proceeds for debt reduction at their level and also for a special dividend that they intend to go ahead and give. So now what happens is GMR family stake increases in GMR Airports and Group ADP stake marginally reduces.
All right, Vivek, thank you very much for that. Keep an eye out on that stock as we open up this morning. IKS is the next one we want to address, and Vinny's got details here. Vinny, take it away.
Hi, good morning. So IKS Health has actually announced to acquire TrueBridge, which is a US-based company. So they will be acquiring this through their wholly owned subsidiary, IKS Inc. 100% stake is what they'll acquire. TrueBridge is a listed entity, so they will first delist the entity and then they'll merge it with the company as well. Do not forget the funding for this. How is that going to be happening? They're going to be approximately raising 600 million debt, which will be secured for a term of 5 years. The enterprise value right now for this acquisition is around 550-60 million. So watch out for that as well. The deal is expected to be completed by Q2 FY27. It's an EPS accretive and a profit accretive in FY27 deal is what they're saying. Margins. Now, when you look at IKS's numbers, 9-month time period for FY26, margins were at around 33% that you could say. TrueBridge, the adjusted margins for this period would be at around 20%. So overall, the pro forma EBITDA margins right now would come in maybe at 26%. So maybe the dilution we could see for some period of time. But IKS has that history, equity which they required. They managed to bring the margins in just 4 quarters to the company level margins. So that'll be interesting to see in terms of margin front. A lot of synergies that will come in for the company as well. Given this acquisition comes in, they serve some rural hospitals where IKS Health is not there. There will be cross-selling that will be beneficial for them as well. And outsourcing penetration for RCM will be key. Management has given a vision of 2030 as well. Net debt, they expect that to be at around 300 crores. While in terms of revenues, they expect that to reach 3,000 crores from currently around 1,000 crores.
Thank you, Vinny, for that. Here's a quick recap then of the top stocks. Stocks with positive news flow are Tata Capital, Himadri Specialty, IKS Health, Bluestone Jewelry, Mahindra Logistics. Stocks with negative news flow are Infosys Scient and GMR Airports. We'll wait to see how LTI Mindtree and United Breweries. It's a mixed picture for them. But moving on from equities and stocks to commodities, Manisha joins in as always.
Thank you so much for that. I'll start with the crude oil prices, where we have seen the Brent climb above $106 a barrel right now. It has been a 4% of gain overnight, and this is one of the very strong weeks that the crude oil prices are putting across. 18% up for crude in this week, with the U.S.-Iran peace negotiations stalling, and it's also about Iran seizing a vessel in Strait of Hormuz, U.S. forces boarding a supertanker carrying Iran oil, and then the U.S. ordering the U.S. Navy to shoot and kill vessels laying mines in the strait. All of that is adding premium to the prices. Markets also reading into the fact that it has been about March and now April as well, 2 months that the Strait of Hormuz has been partially or mostly closed, and that impact also is coming into the crude oil prices. For the longest time now, we have seen the futures continue to trade lower than what the physical markets are doing. So the physical crude is trading $20 to $50 a barrel on the higher side versus the futures market. So it continues to be quite strong, with more and more banks and brokerages now putting out their forecasts on higher crude oil prices in the month of May and beyond. But it's not just crude. The Baltic Dry Index is at a 4-month high. You have Wind Energy Index at 2008 highs. Lithium carbonate prices have gained up by 50% in this year till time. The only thing that has seen a bit of a decline is the precious metal prices. So gold and silver headed for a weak week, but everything else in energy and metals on the positive side.
All right, Manisha, thank you very much. For that, we'll take a quick commercial break here. We'll connect with the management of Aequs to discuss the company's business outlook and F527 roadmap. Stay tuned, coming up. Okay, welcome back. We've got our first management on the program now. Aequs is in focus. This after news came out that global toy giant Hasbro is looking to stop placing purchase orders with Aequs. Just look at the stock price for the last 6 months. If you can have a price chart up, it's really picked up. Had a subdued kind of list, had a decent listing, and then didn't do anything for a while. And in the last 1 month, it's up almost, I think, 50%. Actually, bulk of the gains have come in the last 1 month. Almost a vertical spike. There's, I guess, been buying from some, funds in the defense space as well. I think HDFC Defense Fund has been buying this, some of the names, of course, publicly disclosed. For those of you who don't know, Aequs, of course, is into aerospace component manufacturing. Works with some of the largest plane companies in the world, actually both, that is Airbus and Boeing. And of course, it's also got a toys business. Most of it, of course, goes outside India, which is exported. Arvind Meligari is with us, Chairman and CEO at Aequs. Mr. Meligari, good morning. Great to have you with us here. Thank you very much for joining us. Prashant this side. So, the news around Hasbro, sir, if you can tell us what's happened and whether this is cancellation of an existing contract which was running, or this is the intent to stop purchasing in the future?
Yeah, thanks, Prashant. Good morning. It's customers make their choices, and we are basically dealing with that decision what they have made, and it came as it was not something which we are expecting at this point in time, but historically, the customer has been up and down, and we have other customers who are more strategic. We are working with them, and we feel that, end of the day, this decision came and we had to communicate, and we have communicated, and this should not have any impact in our growth overall as a business. As you know, overall, aerospace is 89% of our business as of today, and overall consumer is only about 11-12% of our business. And our consumer is majority of the consumer growth is driven by the consumer electronics as we go forward. And, with the specific to this specific customer, we are working with them on a separation agreement and figuring it out. And as we get more information, we'll share. And hopefully by the time of our conference this quarter, we should be able to give more clarity. But overall, I can say in the big picture and long run, it should not have any impact on overall what we want to be as a company.
Okay, 89% is aerospace, and that is how's business there, sir? I mean, is that
we've grown 30+% last quarter, and we see a good visibility. We have $815 million order backlog. We see a multi-year, next 5-year growth path, very, very solid for us.
Has this war and so many, I mean, some of the largest airlines in the world, of course, cutting back, right, aggressively. Some of the biggest capex spenders have been airlines out of the Middle East in that sense. So it's like a butterfly effect, right? Airlines cut back, hits the plane makers, and then in turn it comes down to component providers like you. Has that ripple effect shown up in any way?
Not really, because if you really look at it, aircraft order cycle is 10+ years out. And currently our customers have, Airbus and Boeing both have like a 10-year order backlog. And if anybody wants to delay or cancel, there are plenty other people who are willing to pick up. And, this industry has lived with oil prices going up and down all their life. And they know how to manage. All these are short-term bumps. And we being a supplier to the OEMs, we have no impact from that perspective. In fact, customers are making sure that we're able to ramp up, which Airbus is going towards 75 aircraft per month on an Airbus A320, and they're making sure that we can support that from current level of somewhere around 55 to 60 level. So that ramp continues to happen, and Boeing is ramping up. So we don't see that as an impact at all, because we don't really support aftermarket services. And aftermarket is where this impact will be seen. And that happens already happening in the market, and mostly in Western customers who are seeing that impact, because number of flight hours will be less. That means less maintenance will happen. So, but we are not exposed that much to the aftermarket side of the business, and OEM order book is solid, over next 10 years.
Mr. Meligri, morning. This is Rima here. Just getting back to the Hasbro issue and trying to understand the why behind the exit. Hasbro has been a partner for you since 2016. Any indication given by them for the reason for stopping new orders? Was it an account of pricing? Was it an account of quality issues? And you would have heard in the industry, right? Who would their partner be? Is it someone outside of India? Are they looking to tie up with someone in Vietnam, Mexico?
They've basically communicated their strategy has changed, and they want to, more focus on Indonesia. That's what they've told us. And we respect their decision, but there are obviously, certain things which we have to work through between us to make sure that it happens properly. And our teams are working together on that. So it's a global business. That's what we have to live with. And we are competitive. We have been competitive all along, and we have delivered value to them over the last 10 years. And we continue to deliver value to our other toy customers. And I don't think that has changed anything in our way of where we are doing the business.
But you just infused 14 crore into the toy subsidiary. Now, will, this, with Hasbro orders not coming through, will there be a significant underutilization of your asset? And on account of this, in FY26, will there be a widening of losses purely for the toy subsidiary versus FY25?
No, it won't be, because our order book is still solid for the toys. We will continue to deliver current orders, what we have for Hasbro also. And also Metal, as you know, Metal is another large customer to us. We have a large contract with them, and the investment has predominantly gone towards to support their requirements, and we don't see that as an impact. And we are whatever we had planned for the current year, we'll continue to execute that.
Okay.
Yeah, got that. You will continue to execute. Just F5, since we have you, Mr. Meligri, F527 for the business, where will you end up at a net level, just broadly? We won't hold you down to the numbers. It's a volatile environment, but what's on your mind?
Well, look, I can't, we are literally at a period where we cannot communicate from that numbers perspective, but generally I can give guidance We continue to grow aerospace at 35% level, what we see, growth level. And our consumer business is growing at 50% level, year on year. And we feel very solid position in there right now, and we have no reason to be concerned about our growth opportunity, and execution is where we are focused on right now. And as our consumer utilization improves, our margins will reflect that very, very, very quickly. And that's our focus right now.
Got that. Thank you very much. We wish you all the best of luck, Mr. Miliguri. Appreciate your time here, and thank you for joining us.
Thank
so
you,
that's Aequs with perspective on the business. I mean, almost 90%, of course, is aerospace, 35% growth guidance there, and 50% on the consumer side is the... I mean, I think perhaps that is the reason why, even though that Hasbro news did come 2 days back, stock barely budged. I mean, sort of, in a way, shrugged that off. And yesterday was down 2% along with the rest of the market. We'll take a quick break here. Siddhartha Khemka of Motilal Oswal Financial Services with us on the other side.
Welcome back. Let's welcome Sid Khemka of Motilal Oswal Financial Services on the show. Hi, Sid. Good morning. Good to see you again. Sid, we've got a lot of IT companies that have come out with their numbers, and leading the pack on the disappointments is Infosys. Though the sector itself has been a little bit under the weather all of this week, and Infosys is down 5.5–6% just in the last few trading sessions. Any of these disappointments in terms of numbers are presenting buying opportunities? Would you look to get into any of these tech names?
Nigel, glad to be on the show. So I think a lot of numbers, yes, but clearly the commentary shows that the near-term weakness would persist. And especially if you look at AI, what we see is that it's a two-edged sword. On one side, while AI-driven projects are being seeing some traction, the AI benefits that the companies are acquiring are being passed on to the customers. Hence, we are not seeing any accretion in terms of margins. Clearly, there is a miss from Infosys, and what we have done is we have cut our estimates by about 2 to 4%, while the deal wins remains healthy. But as I said, the AI productivity savings are being passed back to the clients, and hence not being visible in the numbers. The only part that I would say is that a lot of these negativities already in the price, unlike an HCL Tech where we saw a big disappointment. I think with Infosys, the disappointment is only to the extent of the softer guidance. So we may see some subduedness in the near term. But again, if you look at the balance sheet, the strong free cash flow that they are doing, dividend yield now climbing to about 5.4%. The downside for Infosys looks limited.
Downside for Infosys looks limited. Some interesting lines came out from the Infosys conference call yesterday. Salil Parekh said on AI rationality, on pricing, etc. He's like, we do see sometimes a particular sort of competitor doing pricing which seems unusual. Unusual was the word he used, but that's happened over the course of the last many years for different reasons. It now may be linked to clients' mind to AI productivity. So there are instances of unusual pricing. And then when they were asked on AI pricing, the CFO, Jayesh, said that AI projects come at better pricing and therefore reflects in better margins. But they also have a higher cost compared to the regular project because talent is a premium talent at this point of time. So they may be making more, but they also have to put their best talent on it. So the costs associated with these AI deals are also on the higher side. Siddharth, you're looking at Fortis Healthcare. Recently, Motilal Oswal initiated coverage, and you believe the turnaround is complete now.
Yes. So, Rima, if you look at post the change in management, what we are seeing is that the ownership has moved to IHH Healthcare. That happened in FY19. The company transformed into a professionally managed platform which supported the balance sheet cleanup. The company exited from some of the non-core assets. Plus, we also saw the financial performance improving meaningfully from there. And hence, what we are also seeing is that the EBITDA grew at about 33% CAGR. There was capacity expansion and as well as efficiency gains. from here on also, now we believe that there is a strong rationale for looking at Fortis going ahead, given that the improving growth as well as margin trajectory would lead to further growth, both in terms of EBITDA at about 18%, 17 to 18%, and net profit CAGR of about 22% going forward. Overall, what we see is that it's a strong story post the turnaround as well as the cleanup of balance sheet. There is a healthy brownfield-led expansion that is happening, plus the diagnostic recovery that aids incremental upside. The Agilus diagnostic is emerging from the transition, and now with utilization-led growth, improving realization, as well as hospital integration, that is driving the gradual margin expansion. So overall, a strong earning compounding with the improving return profile. We believe that there is further scope for re-rating as the return ratios improve. Hence, we have rated the stock as a buy and with a target price of 1100.
Okay, what we're going to do is, Sid, stay with us. We're going to look at some of the delivery stats yesterday with regards to big moves. Are they backed by delivery or not? Gives us a good indication of what's going on. Hormuz, as always, has got that list. Hormuz, take it away.
Morning, Prashant. And two sectors that stood out in yesterday's trading session. Let's start off with the positive one. Was first up. It was pharma, undoubtedly. And almost every other pharma company did very well in today's session, with be it Dr. Reddy's or stocks linked to Dr. Reddy's. Dr. Reddy's, OneSource did very well yesterday. Shaily Engineering, Piramal Pharma, all of them were up anywhere between 8 to 10% in yesterday's trading session, and all of them gained on very high volumes as well. Dr. Reddy's had more than 1.5 crore shares were traded. That is at least 6 times higher than its 20-day average. OneSource was 4x its 20-day average. Shaily was 3x, and Piramal Pharma had over 5 crore shares that were traded. The 20-day average is only 30 lakh shares. And even if you take a look at the delivery front as well, Dr. Reddy's had close over 20% of its shares marked for delivery. OneSource, Shaily Engineering, Piramal Pharma had 5x of its 20-day average marked for delivery, over 50 lakh shares marked for delivery. The 20-day average is less than 11 lakh shares. So a good day for pharma stocks backed by volumes and delivery as well. Now, Data Patterns was another stock that did very well in yesterday's trading session. It was the third straight day of gains, and in this 3-day period, the stock has gained almost 20%. And volumes are on the rise for 5 straight sessions now. And Thursday's volumes were double that of Wednesday. Close to 60 lakh shares were traded yesterday. 20-day average of 10 lakh shares, and 7.2 lakh shares marked for delivery. The 20-day average is 2 lakh shares on this front. The stock in the month of April has declined only thrice, up 37% so far this month, and had a 52-week high on Thursday, the most traded non-Nifty stock on the Nifty 500. And lastly, the segment that did not do well yesterday was the auto stocks, and Ashok Leyland, TVS Motors, Mahindra, the entire sector faced some selling pressure yesterday. And all of the put options on these stocks were very active, premiums going up anywhere between 50% to 80% in yesterday's trade. Now, if you take a look at the volumes as well, Ashok Leyland's volumes were in line with the 20-day average, but that is, of course, there was one day when it had some outsized volumes over the last 20 sessions. But look at TVS Motors, 3x its 20-day average, Mahindra and Mahindra 2 above its 20-day average. And on the volumes front as well, TVS Motors had 12 lakh shares marked for delivery. The 20-day average is 5 lakh shares, and for the other two, it was mostly in line or slightly above their 20-day average as well.
Okay, all right. Got that, Hormuz. Thanks a lot for that. Well, we'll slip into a short break. We come back, we get the pre-open rates. We'll also have Bhavin Shah of Samiksha Capital, who will be joining in to discuss Q4 numbers of Infosys. Stay tuned.
Welcome back. Siddhartha Khemka, Motilal Financial Services, is with us with what he'd want you to do with regards to specific trades and, of course, the broader market sentiment as well. CleanMax is a company, Sid, I don't know if you've looked at it, debuted recently. It's just 2 months old. I think this is the second month. 1,052. It's been a good month. Listed at about 960, it's at about 1,052, or listed at 960 and then fell to about 700 and is back at about 1,050. One of the larger players with regards to setting up renewable capacity, especially for the commercial and industrial side. basically they work with businesses on long-term power purchase agreements. Returns are, I mean, it's a high capex business, but I think returns, etc., are, assured, kind of regulated, but assured for the life of the contract, which could be as long as 15, 20, 25 years. Any thoughts, Sid?
Prashant, unfortunately, they have not looked at this company, but what we believe is that this entire renewable energy business, especially given the current global energy crisis, should do well. We are positive right from the utilities, which are the renewable generation companies, to the distribution. And even yesterday, we came out with a report on Fujiyama Power Systems, which is an integrated play on the rooftop solar business. We believe that India's target of about 100 gigawatt rooftop solar target, which is a strong policy push from the government, plus the company, both backward integration is driving margins, plus capacity expansion, and its integrated product ecosystem, which is your solar, storage, as well as electronics. That benefits from a rising adoption, plus the bundled solutions that they are providing. And with a pan-India network of presence of 900 plus distributors, 6,000 dealers, and enable it to see a good deep retail penetrations, supporting the scalable growth and demand. So overall, we like this space, and some of our top picks, Acme Solar in the power generation, Fujiyama in the distribution segment.
All right. Sid, I wanted to ask you about the Vedanta stock. From the time the demerger is announced, the stock has come down to around 735 rupees. And there could be various reasons, right? Some of those that have the position in the FNO, they may not want to hold it because now they'll be left only with the holding company, at least for the next 1 month, since only Vedanta Limited will be listed initially. Besides that, from a fund manager perspective, sometimes there's a restriction on the number of stocks they can have. So from having one, they'll suddenly have 5. So that's why they'll be forced to knock off a name. And that could be the reason that we have seen a bit of a pullback. From 780, 790, stock has come down to 730. What's your view on the stock? I'll tell you where the upside comes in from. You have Hindustan Zinc that is listed, so you get bulk of the value from there. And the aluminium business, the street is still working with $3,000 a ton when the price is actually $3,500 per ton. Would you be interested, or do you believe Vedanta has run its course?
Yeah, Nigel, I think some of these corporate actions do lead to some of these non-fundamental technical factors. As you rightly said, some of the portfolios would not want the stock to see a loss in the between and wait for 1.5 months, 2 months for the new shares to get listed. Plus, I think a lot of run-up has happened in anticipation of this demerger, and some profit booking is taking place. But what we believe is that Vedanta is kind of a proxy play to the overall metals commodities sector cycle that is seeing sharp up move. So the global commodity up cycle is likely to continue, supported by the ongoing cost reduction initiatives that the company is doing, plus the capacity expansion towards the higher value-added products. Yes, some of the core businesses of the 5 that will eventually get listed, aluminium, iron ore, and then your oil and gas. I think these are the 3 commodities that will remain listed, and the aluminium business is something that would be bulk of the valuation that it will command. I think tactfully, if someone is willing or have the patience to wait out for the entire demerger process and the relisting, I think it's a good opportunity to add on dips before the record date and benefit, because once the new companies get listed, we'll again see a lot of fund managers, institutional interest towards the specific commodities which are getting listed separately. So I think, yes, it's a steady growth outlook, plus it's a good opportunity for investors who are willing to wait out the entire demerger process.
Okay, got it. All right, Sid, thanks a lot for joining in. In fact, we'll be deep diving into Vedanta on Editor's Roundtable later today. I'm going to explain the business, and then we're going to be putting some important questions to Sanjay Parekh as well. In the near term, there appears there is some profit-taking that's taking place on the counter. Thanks, Sid. Have a good day ahead. Well, let's welcome Shrikant Chauhan as well as Sudeep Shah, who join us on the show. Hi, gentlemen. Good morning. Good to see you all in. Sudeep, you go first. What's your take on the Nifty? Last few days has been a little bit iffy. The problem is crude oil prices as well have spiked up by $4-5 a barrel overnight. Where does support come in on the Nifty? And with this 100-point gap up that the gift Nifty was suggesting, what would you do?
Good morning, Nigel. Nigel, see, if we see the trend of Nifty in the last 10-15 days, right from the lows of 22,200, there has been a steep rally now. Suppose that it's just a bit of consolidation that we have come under. And overall, from the lows of 2nd April, 22,182, and till the highs of 24,600, even if we see, say, somewhere around the 23% retracements also works out somewhere closer to 24,000. So what we feel is that this 23,950, 24,000 band will act as an important support on the downside. It is just that the last 3-4 days have seen some bit of profit taking and some bit of fatigue at higher levels. But I feel that 23,950 now will act as a stronger base. We might still continue to consolidate, but eventually higher levels of 24,500, 24,700 looks likely. So buy on dips would be my strategy, even if the markets are opening, say, a flat or a 30 to 50 point gap up or gap down as suggested by Gift Nifty. But overall 23,900, 950, 24,000 will act as a stronger support.
Got that. Sudeep and Shrikant, good morning. Shrikant, what about you? How are you looking at things?
Good morning, Prashant. Good morning, Nigel and Rima. So when looking at the setup of the market and the way it retraced to the levels of 24,500 and 600, and now again the things are like turning little bit negative, like currency is above the levels of 94 and crude is around $105, $106. I think till the market is not crossing 24,600, we can expect some correction in the market. And the important thing is that it should not close below the mark of 24,000. In case if we see the market is closing below 24,000, then we can expect further more retracement in the market. Even if we go through with the sector-specific performance, then IT is not at all performing. In fact, it is not supporting to the entire performance of the market. So in that particular scenario, we need to be more and more stock-specific rather than focusing more on indices.
And what would those specific trades be then, Shrikant?
So in that, I think, see, like since last 4-5 days, as the ceasefire had started without any deadline, the flows have started moving towards defensives, especially FMCG and pharma companies. In that, we like pharma companies because there we are seeing some strength and gradual upward activity. Most of these stocks are very close to their important resistance level. In fact, Glenmark Pharma has crossed its important level. And from current levels, the stock is currently quoting at 2350, but we can expect 2500 or 2600 sort of level. So there we need to be a buyer, even at current levels, more on dips with a target of 2600. The other space on which we are bullish is power and power equipment related stocks. So in that NTPC, Power Grid, I think these are the stocks to buy for. But while looking at the sentiment of the market, if we have to create any short position, then Ashok Leyland looks weak. Currently, it is around 170, 171 levels, but the stock can fall to the levels of maybe 160, 162. So here we should look for creating some short positions with a stop loss close to 174.
Okay, all right. And Sudeep, what about you?
Nigel, two themes which have picked up interestingly in the last few sessions. One is the capital market theme and the second being the defense theme. So from the capital market space, CAMS is that stock which is on my radar. Closed almost around 770, 775 levels yesterday. Stock has crossed its 200-day moving average after 4 months. Last it had broken down was in late December 25. So we feel that this space is once again becoming more vibrant. Buying on dips is visible here. So CAMS can be bought at current levels and on dips with a stop loss at 748. On the upside, the targets would be 810, 835 in the coming 1 to 2 months. It's kind of a positional portfolio trade. The second stock which is there on our radar is from the defense space, and that is Bharat Dynamics Limited, BDL. Here also there has been a clean breakout yesterday backed by volumes. And we feel that lot of most of these defense names have given good traction in the last few days. So with BDL also, we feel that this can be bought at current levels and on dips to 1400. The stop loss would be 1380. The targets would be 1480 and 1510.
Thank you, gentlemen, for that. We'll come back to you. In pre-open, Infosys is down nearly 2%. In fact, all the four IT companies have disappointed in Q4. In the case of TCS, it was the miss on the company's margins, even though the revenue performance was actually pretty okay. The company's revenues went up by 1.2%, but the street argued that you had 110 basis points improvement in your margins, but only 10 basis points got reflected. In the case of Wipro growth, they've been struggling on growth. In the current quarter, they got the M&A boost, the Harman DTS acquisition, but it didn't really show up in the company's top line. Organic revenue growth was significantly lower. HCL Tech had flagged off discretionary spending cuts in telcos, project cancellations, SAP project cancellation. So there was a sharp drop-off in the company's revenues. Infosys too has missed the mark on the company's top line and margins. And now when we look back at FY26, it's been a third year of weakness for the company. For TCS, it's the first negative revenue growth since inception. They ended the year with a cut of 2.4% last year. For Wipro, revenue declined 1.5%, declining for the third year in a row. HCL Tech ended the year with a 3.9% growth, but they also missed their own guidance, which they had given in January, 3 months back. Infosys, 3.1% growth for the full year, but again, it's at the lower end of their own guided band of 3 to 3.5%. And the FY27 guidance isn't suggesting an acceleration compared to FY26, which is what the street was hoping for. For HCL Tech, the revenue growth stands at 1.1 to 4%, while for Infosys, it stands at 1.5 to 3.5%. The takeaway is that FY27, no acceleration in growth compared to last year. Bhavin Shah, founder, CIO, CEO, Samiksha Capital, and he's been a close watcher of IT now for so many decades. He looks at the market, individual stocks as well, but he's got a keen eye on IT and the mood, the pulse, and the investor view towards IT. Bhavin, your first take on the IT numbers so far, and what does it tell us for FY27? What should shareholders, investors do?
Yes, I think it is certainly disappointing, although not unexpected outlook for the sector. If you compare it to, say, a year back, what people were looking for FY26 is clearly a step down in expectations and, growth outlook for FY27. So obviously, because of the confluence of factors with the whole, the AI-led improvement being the new and very significant factor at play. And so I think for the investors, there is not much to play with. Definitely not in the large cap IT. In a small mid cap, there might be, some very, very select opportunities, where there might be a company specific growth story playing out, even amidst all this, because, for a smaller company, it is easier to still grab some new business and still deliver growth. But even there, if you would have noticed, the companies that were growing at, say, 20%, are now, people are happy to if they are saying 10, double-digit growth. So yeah, it is a tough space to be an investor, and it's in a portfolio. I would suggest very low allocation, if any.
Low allocation to IT, if any at all. So for this kind of growth, say a 2, 3, 4% kind of a top line growth, and a little better on the EPS front, what is the appropriate valuation for large cap IT companies to your mind?
I mean, the way I look at it is, I like to say that to invest in a large cap IT, one would, these are liquid names, at least still some fair bit of stability in their cash flows. So let's say you are okay with 11, 12% return. And then if the underlying growth is, let's call it maybe 3, 4%, including some currency benefit, as you said, then you have to get down to low teens or 10, 12 kind of P multiples for them to be attractive investments.
Even taking into account the dividend yield, you're saying the appropriate valuation multiple should be low teens? Because there is significant de-rating from here on. Already, IT companies are at, say, 16, 17 times. But you're arguing for lower valuations.
Absolutely.
Okay. What about companies like a Persistent, Coforge, which are growing well, But as you pointed out, these were companies growing 20% plus, and now perhaps will grow at 15%. Are these companies also trading at expensive valuations to your mind?
Absolutely. The whole sector needs one more valuation reset. We had one valuation reset. We saw a bit of a rally, but I think that rally is not going to find support. If you just notice overnight, the major tech companies in US, Meta, Microsoft, they all announced large job cuts. And we know that Indian IT services companies are essentially, they have been growing through the growth in headcount primarily over a long period of time. So when the whole industry is shrinking in terms of number of people required, then obviously it's not a great place to be.
Yeah. No, absolutely. Bhavin, morning. Prashant here. Good to see you. There is, and that's the point. I mean, high tech is, of course, getting impacted first, as someone said. Well, right. But everything else also perhaps gets impacted. But at the same pace or not is the question. From you've named names like Sonata in the past. I'm not sure if you still have that in the portfolio. I've heard names like First Source as some of the smaller companies, perhaps more agile, more AI first in their approach. Is there a way to look at any of these names as opportunities, maybe on the product side, and not just pure services? What's your sense, Bhavin?
Well, yeah, product, for example, we have some of these listed companies in the banking software space. They might have some bit of defensive position, especially in that space. But again, one has to look at individual opportunity. We don't have any investment there, but it's something one can think about.
Do we have him?
Then there is the if you talk about pure IT services companies, again it is case specific. We don't own Sonata, we do own Mastech. It is corrected a lot. I think company has shown a very strong growth in order book, and so we are continuing to hold it. But we won't go aggressive there either.
So you're not buying the dip on Mastech as well, a stock that you like and you believe in the long-term story.
He owns it.
Yeah.
Yes, we do own it, and we have confidence in the management to deliver reasonable growth, especially considering the valuation.
Any other stock that you own in IT or you're looking to add?
We own stocks in IT related areas, healthcare IT, for example, companies like Aequs, for example, or even Sagility. Again, we won't build more aggressive positions there or increase our positions there, but we think that these companies do have the ability to take advantage of AI. But they also face disruption. The shrinkage in how much customer would be willing to pay for the same work, and so on and so forth. So that pressure also will be there. But overall, we think that if they adopt AI well, then they can still grow because their end market is fairly large and still have room for growth.
All right, Bhavin, appreciate you joining in. I believe we had a late night cricket game, but made it in the morning for the interview. So appreciate you joining in and giving us that quick analysis. Have a good day ahead, and we chat up soon. Well, the markets, I think, are set to open up in the backdrop that actually the global cues are a little bit iffy because crude oil prices have spiked up, the yields hardened a little bit, and the dollar index as well was strong. I'm not sure what the rupee had opened up, but I think maybe we could get that as well up for you on the screen because the last few days it slipped from sub that 93 odd mark to around that 94.1 odd mark. So the rupee will be in focus as well since the FIs have turned smile sellers over the last few days, Prashant.
Absolutely. I think we got market open right in queue. What do we have? 24,130. So if you're able to get away with just that, I mean, outstanding. 24,160, actually in the green now, 24,190. The Nifty Bank is up about 0.25%, and the mid-cap index is up about 0.29. The small-cap index will come up on your screen as well with a quick sort of check. 1,200 up and about 420 lower. That's the advanced decline ratio. Almost 3:1 right out of the gates. And of course, that number will move around But to begin with, this is, great. Yesterday, the two indices which were under maximum pressure were the Bank Nifty, which was down 1.5%, and the small cap index, which was down 1.5% as well. Nifty was down less than 1, mid cap index was down less than 1. So, that we'll see if private banks and public banks in the small cap space, how that fares at this point in time. It's a broad bid, I think, in the broader markets because both indices are up and about so far. What do we have in terms of the Nifty heat map? More up than down. Max Health, Grasim, Bajaj Auto and Indigo are some of the movers on the upside. And Infi, Cipla, HCL Tech and Dr. Reddy's are stocks which are on the downside at this point in time. A little more pressure emerging. We're down about 46, 47, 50 points now. So 24,120. Rima.
Well, the culprit today is IT. The Nifty IT index is opened with a cut of 1.5%, followed by the pharmaceutical index. Pharma index is down nearly 0.6%. So if you look at the losers right now, it's Cipla right on top, 2.5%. It had rallied yesterday. Dr. Reddy's was up 10%. It's given up a fourth of those gains, 2.5% down at open for Dr. Reddy's. Sun Pharma is weak in trade. The headline today in one of the pink papers is Sun Pharma looks to outshine rival bids with a $13 billion offer for Arginan. Excuse my pronunciation. Then you've got all IT names weak in trade. HCL Tech continues to flounder, 13% lower this week. Infosys has opened in the red. The cut is not deep, but 1.5% lower in Infosys, reacting to numbers with a downtick. This week, Infosys is down 7%. And for the month itself, remember, IT stocks had rallied nearly 10% going into the numbers. And now Infosys and HCL Tech are actually down for the month of April. So they've given up more than what they had gained, once that relief rally was taking place on the back of the rupee depreciation. ITC, ICICI Bank, Power Grid are a couple of the other names which have opened in the red. On the way up, you've got consumer names continuing to climb higher. So Nestle is on top. Coal India is seeing buying. ONGC benefiting with crude at 106. M&M, Max Healthcare up and about. Bajaj Auto, L&T, Eicher Motors are some of the other stocks. So it's slightly negative for the benchmark indices, but it's on account of IT and it's on account of Dr. Reddy's. And some news coming through on Dr. Reddy's. We'll wait that. I think Newsbreak confirmed about the semaglutide in Canada, but we'll wait for that flash to come through.
Well, that's right. A few stocks, Rima, that are looking quite good this morning. Rolex Rings, I think they have gone ahead and they've announced a buyback overnight, so that explains why that stock had popped up closer on 2%. But otherwise, in terms of earnings reactions, well, there are quite a few actually. You have Himadri. That stock is up and about in today's trading session. Solid move is what we're seeing post its numbers. We'll hear from the management in just a bit. Bluestone, that's the other positive earnings reaction. So that stock as well has gapped up, and we'll hear from that management at around 10:30 a.m. CIE Automotive, that came out with its set of numbers as well, and that as well is fairly impressive. IEX, well, that stock has taken a pounding, but that's opened up actually in the green, up closer around 1.5%. IKS, they announced that they're going to be buying TrueBridge for around 550 million EV via debt, and they'll merge the company as well. The street's taken that positively, so that one as well opened up in the green. Some of these solar plays, though, have come in for profit-taking. Vari Energies is down, and Prima Energies as well. Both of them are down between 2 to around 4% because of the news flow overnight with regard to restriction into the United States. The ADD on solar imports that's been announced in the United States explains why both those two names are down. So though the headline index is still down 50 points, there are some positive earnings reactions that you're seeing. The breadth of the market is still positive, and the mid-cap index has moved into the green. So a flattish start on the headline index, but plenty of stocks doing a thing of their own from the broader markets.
Okay, well, I think, it's not a bad start at all, given, the combination of higher oil and the software sell-off last night, and markets are holding. I wonder, just at the margin, how much of this is, optimism around, the elections which are going on in West Bengal, the 90% turnout, voter turnout, which is unprecedented. And so I don't know, but, we'll know post, I think the last phase is 29th. Post the 29th of this month, we will know, which is basically next week. Let's welcome in Gautam Shah, founder, Goldilocks Global Research. Gautam, good morning. Great to have you with us here. Thanks for joining in. Gautam, you are in... Are you in Calcutta?
Morning, Prashant. No, I'm in Dubai right now.
You're right now. Okay, I'll ask you a political question before charts, Gautam. So how are things looking here now in terms of the indices? Let's start with the Nifty Bank, etc. You know, fundamentally, Gautam, it's that kind of a market where 1,000 points lower, there are India upgrades which come. These are strategy reports. And the market rally goes up 1,000, 1,500 points, there are downgrades. We've literally seen that, at least three of them. And that kind of tells you about the state we are in. What's your sense, Gautam?
Well, I think the markets have been reacting to all the geopolitical news flow that we've got in the last 1 month, and all that's happened at the markets is because of that. I believe that the worst of the geopolitical news flow in some sense, because market believes that the peak intensity is out of the way, that could already be in the price. And I also believe that the good news from the geopolitical situation of a possible resolution to this war or a ceasefire is also in the price, because it's not just India. World over, we've had a massive rally in these last 3 weeks. While the Nifty is up about 11%, on an average, world markets are up about 15%. And if you look at the US market indices with what the S&P and the NASDAQ have done, it's clearly almost as if the market is beyond the geopolitical news flow right now. So as you might have been noticing in the last 4 or 5 days, despite all the news flow around it, the markets worldwide have not reacted much. I think with this recovery, the market has done its bit for now. I think 24,600 was an important resistance. We've seen a bit of a correction from that particular number. I think now we'll go back to normal business. And I don't think people should start extrapolating that just because we've had such a good last 3 weeks, it doesn't mean that all is well once again and we keep going up and start making new lifetime highs. I don't think that's going to happen, because we go back to normal business. We go back to looking at earnings, fundamentals, consumption, AI disruption, and all of these factors are still impacting Indian markets, and the fact that FI selling continues. So I think we will yo-yo in a sort of a range, 23,500 on the downside, 24,600 on the upside, and we need to go through a consolidation patch. So I am not excited at all for the Nifty or the top 100. I think they will just be very boring in a sort of a range. But the real opportunity, as I've said multiple times, is micro caps, small caps, and mid caps. The micro cap index is up 22% from the recent low of 19,000. And I think the outperformance is here to stay for the rest of the year. So staying in the right pockets is important. And with two major heavyweights of the Nifty, which is IT and Reliance, not delivering, it's very difficult for the markets to continue to rally, because there is just too much responsibility on the banks. And I don't think they are at a point where they can move up significantly.
Well, it's a narrow range, Gautam, that you're anticipating that we will oscillate in just about, 1,000 odd points on the Nifty. So clearly large caps, no go. They won't see, even if there is volatility, perhaps you won't see some big moves. Tell us some ideas in this micro cap, small cap space. What are the themes one should look at?
See, let's not forget, we were at the depths of pessimism close to levels of 22,000, which I always thought was a long-term support. And I'm happy that the markets have recovered from there. Obviously, it's been a very large rally in these last 2.5 weeks. A lot of stocks have done well. Now, I think we go back to the broader markets. And within the broader markets, I think energy-related stocks, power-related stocks, metal stocks, PSU stocks, I think these are the big opportunities. I mean, I've said this multiple times in the past as well. I'm sticking to this basket because I feel there is new leadership that has really emerged in this space. I mean, look at the metals index is at a lifetime high. Look at the comeback in capital goods. Look at also a comeback in real estate. And, PSU, according to me, is probably your best bet for the rest of the year. I mean, they've handled the market weakness really well. They're very steady, nothing to do with foreign policy, excellent dividend yield, under ownership, and they've done all the right things on the charts in the last 10 days. So metals, PSU, and energy, I think, are three baskets that we are really liking. In the broader markets, you could actually buy the entire basket of small cap 100, which has just tested the 18,000 resistance number yesterday. So there could be a bit of a breather, but basket buying for the long term, I think, makes a lot of sense at today's prices.
Okay, all right. You want to give us levels on any of these indices that you're talking about, Gautam?
So I think, as I said, if you look at the broader market indices, microcap index was at 19,000. Today, I think we are close to 23,000. That's a 4,000 point move in a matter of 3 weeks. And I'm tempted to believe that it will do another 5-7% up on the upside, which is towards 24,500. And the small cap index can do about 19,500. But the point I'm trying to make here is the juice of the possible resolution to the geopolitical situation is already in the price. So I don't think if there is good news on that front, markets will continue to rally higher. They will stay in a range. We are still in a large consolidation pack. I don't think the Indian markets are running away. One should have realistic expectations from these levels and stay in the right pockets. I think that's really the key for the rest of the year.
Point taken. So what about politics, Gautam? Will that excite markets from here as a trigger?
Well, it always has, but I'm not sure whether the current political situation can really excite markets enough. You know, this domestic liquidity has been so stubborn. I mean, happily stubborn in this last 1 year. We've had so much in the recent past, but despite that, domestic liquidity continues to be a mega revolution. And that's probably the reason we are at levels above 24,000 today. So I think come what may, the market will stay protected is what I'm tempted to believe. Obviously, if you're referring to what's happening in the region in terms of politics, I think that's a fierce battle. I don't want to get in there. But I mean, we'll all wait as to how that pans out.
How are things in Dubai, Gautam? I mean, generally, day to day, things are normalized?
Yes, it's quite normalized. Schools opened up a couple of days back. People are back to regular life. It's just that the city is missing tourists. Probably that's the only miss, but otherwise it's quite normal.
That's good to know. You know, when you described all that, what's happening with micro caps, and it's all, I was thinking about it, it's almost as if, I mean, maybe not, it's not thought through in that way, but you're kind of steering away from things where FIIs are invested in to a place where there are no FIIs, unaffected by all the selling and everything else. You know, do your own thing, a kind of thing. Is that perhaps a theme one should? It's not a theme. I don't know how you kind of build a portfolio out of that, but perhaps makes sense to look a little deeper into that. Non-FII stocks, basically.
Well, you hit the nail on the head. That's exactly my view, and that's exactly what we are putting out in our reports, that be in stocks and sectors where FII selling is limited and DII ownership is limited. And that's probably the reason I'm really looking at that basket where the market cap of stocks is anywhere between 1,000 crore to 30,000 crore. I know it might be a large range, but that's the basket I'm looking at because, you know, you've seen a lot of these stocks do very well in the last couple of weeks. But, you know, it's quite interesting. I saw the 2003, 2008 bull market, and we always said, be where the FIIs are. You know, so that was a very different kind of a bull market. Right now, we are looking at be where the DIIs are.
Yeah. No, that's be where the DIIs are, be where the local money is. So you don't run the risk of sudden FII selling, and that's been relentless in more ways than one as well. Just run us through your reading of the charts on these power names, if you will, Gautam. I'm talking about all the utilities. Some of them have made all-time highs. Adani Power, for example. You know, Hitachi and GE are another universe. The transformer companies. I mean, what's your reading?
You know, I think it's a market where the older themes are taking a bit of a rest. I see a lot of people trying to buy the older themes thinking that they will participate, but they are not participating. And look at the way the NSE Energy Index or the BSE Power Index has come back in the last 2 weeks. I think it's a mega trend and it's here to stay for the rest of the year. There is obviously a lot of fundamental talk around it. There is genuine fundamental tailwind to it. I think the government realizes its task is cut out in the energy space with what has happened in the recent past with energy security and the way stocks have behaved, you know, where it could be the Adani group stocks or many other stocks in the market. I think this entire basket will deliver upwards of 30% over the next 6 to 12 months in an environment where the Nifty might not even deliver double digit. So I think it's a great space. The entire basket, I think, will be a beneficiary. You can pick and choose. And, you know, in today's market, if you get the theme right, you know, it's very rewarding to pick any stock.
Got a view on crude and gold on the charts? You know, crude cooled off and then bounced back very swiftly. And gold actually, you know, when the markets got a little brittle, people started taking money off gold. And on an asset like gold, it fell more than 20% in a matter of, I think, a few weeks. Your view on both these two?
Well, I think crude will stay elevated. I don't think we have a resolution to what's happening in the Middle East and the US verdict and feeling about the rest of the world. So I think crude will stay elevated and India will have to deal with it. There is no doubt about it. And that's probably the reason every time we start to move up, we will find selling pressure because our fundamentals will come into play and will not allow the markets to rally beyond a point. When I say market, I'm referring to Nifty and the top 100. So I think crude will stay elevated. 80 will be a sort of a base. 110, 115 will be a sort of a ceiling. So what was 65.70 earlier now becomes 85.90, which is quite an elevation on an overall basis. And if you ask an economist, I'm sure he'll put out numbers there. Gold and silver remains a mega trend. It was a little overdone, went through a bit of a correction. I think it seems to have stabilized. I think it's formed a bottom at the recent low, and gold will probably gradually go back to 50 to 5,300. Silver will probably gradually go back to $100. So gold and silver, for your viewers, please stay invested. I think best is yet to come.
Best is yet to come. That's what we'd like to hear. Gautam, thank you very much. Good speaking with you. Appreciate you joining us, and stay safe. And we'll see you back when you're here in India. But I think just a quick word on the market before we go any further. 115 points lower, and we're at about 24,055 at this point in time. Market breadth is now flipped. It's more reflective of course, I mean, morning when we started, one of the top gainers, at least on the upside, was Indigo. I mean, didn't make any sense, and it kind of flipped a little bit. But 1,700, 1,800 stocks are lower, and about 900 stocks are higher. So this is 2:1 on the downside in terms of what is down to up as far as stocks are concerned. This is the broader universe. We'll take a quick commercial break here. Okay, I'm sorry, we won't take a break. We will, Rima, we have a guest in the studio.
Well, indeed, we've got Aditya Birla, Sun Life AMC in focus on the back of the Q4 numbers. Revenues declined 4%. The company also saw an 8% drop in the operating profit. Balasubramaniam, Bala as we call him, Managing Director, CIO at Aditya Birla, Sun Life AMC, is now here with us on the show. Thank you very much, sir, for joining in. Now, as per SEBI's new BER framework, you've guided for a 3 to 4 basis points pressure on the equity AUM. Does that already include the GST offset? What would the net revenue impact look like in FY27?
I think the way we have gone about assuming is on the basis of multiple round of discussion, right from the first circular when it came and then subsequent engagement with the SEBI, the modification that came, I think we came to the conclusion that it'll have a very least impact both on the revenue as well as the profitability from the broader perspective, given the fact it now narrowed down to about 1 or 2 basis points. Second, as far as the GST is concerned, now there are 2 set of numbers have come. We always used to calling as only one number TER. Now it became BER and TER. Correct. Which is BER is something else, including management fees and other things. Whereas the TER is actually add to the BER, add your GST and security transaction taxes. That has to be disclosed separately. That sets over and above that. So there are some reductions that will come mostly on the brokerage expenses. It used to be somewhere around about 8 to 10 basis points. Now it dropped about 6 basis points plus GST, ultimately remain the same. It's about 8.5 basis points to remain the same. So on the overall basis, I would assume about 2-3 basis points already included in the overall expectation that you have set. Broadly, from the way we have guided to everyone, is the whole system, it'll have to be optimized in such a manner. It has the least impact as far as the AMC's concerns. Also, it's got the least impact as far as the distribution partners' concerns.
Okay. So the impact will be about 2 to 3 basis points net.
On the overall basis.
On an overall basis.
On overall basis.
Look to optimize.
Yeah, that's right. That's right.
Bala, hi, morning, and thanks for dropping by. I hope this is the first of many interactions. It's a new one on quarterly numbers. We talked about what's happening in bond markets and markets in general, but earnings, of course. And AMCs as a business is, many would agree, is one of the few businesses where, the flows are still steady.
Right.
And at Aditya Birla, of course, performance has also become much better. Over the last 6 months, 8 months, it's picked up across the board, across funds.
Right.
And the proof of the eating is in the pudding, right? You will get a larger share of flows as performance picks up. Are you starting to see that?
I think I would say the last year was a good year. I've been saying the last year has been a good year for us for 2-3 reasons. One, as you rightly put it, we invested on people, we invested on process, we invested on improving the performance across all our schemes, especially in the equity. And I'm happy to say that as of March, almost 85% of the funds have delivered Q1, Q2 performance of the competitions. not only beaten the benchmark, it's also, of course, beaten the peer average, which I call it. So that's something is good news. That's, of course, getting converted into some improved flows coming in some of our core funds we already identified, such as Flexi Cap Fund, Multi-Asset Fund, Mid Cap Fund. In fact, we have gone about giving a call this year, irrespective of market volatility, we've gone about giving a call this year. Earnings for the Indian markets have become more better. And equity, as a result of that, as time progresses, when things does settle down, the current uncertain world, we'll probably see flows to reverse from overseas investors in India. Therefore, mid and small cap could outperform. Therefore, we have gone about giving call on smaller mid cap also is worth investing, along with Flexi Cap and Multi-Asset Fund. So we are seeing kind of flows coming in. And second is we are also building our alternate business, which has been one of the increased contribution will come from alternate business, especially on the offering performing credit fund as well as the real estate fund. And we also now opened our Gift City as a 100% subsidiary company of Gift City. It gives actually to open the gate for us to get retail participation coming in the offshore funds, both for inwarding, outer remittance as well as inward remittance. In both the cases, the limit used to be about $120,000. With the 100% subsidy being set up, and we can start accepting money from retail investors. I think we are looking at a holistic basis. As you rightly put it, asset management business has been one of the fast-growing business in the current world in the capital market. And given the fact that huge underpenetration still remains, and one of the things that we keep saying that SIP is the one which has to be continuously promoted. But as a fund house, we have gone about building a SIP for life. And don't look at SIP actually for 1 or 2 year or 3 year. Look at SIP for life. And her girl has to have an SIP. These kind of promotions, I'm sure, will only make more and more people to participate.
In terms of share of flows which are coming in, like for example, industry flows into, I'm just using an example, into the mid-cap category. Do you have targets in mind? I mean, one is of course performing and then is going out and telling the story that the performance is improved and getting more money in. So just like across categories, large, mid, small, etc. And is there a target of what should Birla get as a share of these flows? Where are you at and where would you like to be?
Yeah. No, we generally say, I think earlier we used to have a theme called we should get our deserving market share. Given the fact that Aditya Mutual Fund is a 30-year-old organization, and we have been working towards building the mutual fund business to where they are today. So having been a large player, an old player, large player, established huge track record, a long-term track record that we have, investing on people and processes and so on and so forth, we have a long way to go. So we call it as a deserving market share. What do you mean by deserving market share? It can actually number can vary from say 7% to say 10%. And given of course the competitive landscape, there are almost about 50 players out there. And earlier regime when we used to have about 15 players, we used to say we should have about 10% market share. At this point of time, we are saying roughly about 7.5% it should be our deserving market share, given the fact that we are a large, established Indian conglomerate, most trusted names, and that's something we keep saying it internally.
7% is the existing share.
Currently, we have a total market share about 6.25%.
Of the total?
Of the total assets under management in the industry. And equity is roughly about 4.5%. And in terms of net...
This is the stock or the flow?
I'm talking about overall market share. Overall market in the industry AEM.
Okay.
In terms of flows, we generally get about 5.5 to 6% on a gross basis, and roughly about 4% on the net sales basis. So we generally say that what we set expectation may not be necessarily happening today, but in ideal scenario that we call it a deserving market share, but for which of course we have to earn it by way of giving consistent investment performance and so on and so forth. That we have established it. That's going to be an ongoing process. As every manager go through their own tough time.
Yeah.
And we also gone through our share of pie. We had good time, we had bad time. And I would probably say the last 2 years have been pretty good for us by way of people change that we've made, process change we've made, focusing on consistent delivery and investment performance, and look at market across the market cap rather than focusing only on large cap. Now we have built capability within the team to build the next level of phase of growth. Okay. In fact, we also added our more and more team to the investment side. And to focus on new product like SIF, we need to have a capability before offering the product to the external world. These are some of the investments we are making. I'm sure these investments that we have made, the renewed focus that we are bringing in, which is all I think I probably say reposing confidence on the brand that you have built over a period of time. And that's something that I think is something we are working on it.
All right. Hi, Bala. Good to see you in the studio. A couple of quick questions then. You spoke about deserving market share. So just to clarify on that point, on the mutual fund market share, you're saying 7.5% in the near term. That's in the next 12 to 18 months. Would that be fair? And equity market share, you'll head to around 5.5%. Should that be the near-term goal?
That's a goal. Of course, I cannot say next 18 months. I can't give a forward commitment at this point of time. I think whatever the step that they are taking, the steps they are taking, the way I think things are panning out.
So 50 to 100 basis points.
Our aim would be to grow at line of the market.
All right.
And that's always the aim that we have.
And gain market share of around 50 basis points just in the near term, 50 to 100 basis points.
15 to 20 basis points. That itself pretty large amount.
15 to 20 basis points. Got that.
I think we'll work towards it.
Yes.
But ultimately, we have to continue to keep our head low and focus on the hard work that we have been doing all these years.
15 to 20 basis points in the near term in terms of market share. Got that. Tell us what is the overall AUM target, growth target, if you could help us out with that. And as you mentioned, alternates on a very small base, I think that tripled in the past year.
Yes.
How big will that grow to, and what is the growth trajectory on alternates?
See, we have gone about building this business the last 3-4 years. One, we have invested on people to offer AIF performing credit funds. We did about 750 crores last year.
Yeah.
And I think here also we are aiming close to about $1 billion kind of size we should gun for the next 1.5-2 years.
Okay.
The same way, real estate performing credit fund. Real estate fund, again, focused on credit. We already have about 950 crores kind of size. We've given a very good performance for the last 10 years. So the way we are building is first to showcase our capability, way of delivering good performance, irrespective of whatever the size is. On the basis which I think go and offer a product to the growing HNI family offices invest in the country. That's something we are keeping. The last, of course, is the passive side. Again, we have invested on people. Last year, passive side was the highest growth we have seen.
Okay.
And that's something, again, we are actually bringing in renewed focus on building passive. And passive not necessarily has to be only a low profit margin kind of product. We can even run product which gives a reasonably good margin. So that's something, the third area of focus we are bringing in.
Okay.
And last but not the least is building the equity to the next level of growth. Currently, we have size about 446 crores in terms of assets and management. 227 crores roughly is in equity.
Yes.
And that's something, given the fact that we can continue to grow this business, I think internally we keep looking at the growth has to be in line with the industry. So far, our growth has been a little lower than industry.
That is picking up.
That's picking
hopefully,
up.
that'll be the case. Bala, thank you very much for joining us. More questions, but we're on the earnings treadmill, as you would know. So thank you for dropping by. As I said at the beginning, I hope we do this every quarter. Thank you.
Yeah, we'll do that. Thank you.
Thank you.
All right, we'll take a quick commercial break here. We're going to come back with the management of Himadri Specialty Chemicals on the other side. Stay tuned.
Welcome back. Himadri Specialty, that's the stock in focus. The street likes those numbers because with the markets at the low point of the day, that stock actually is at the day's high. For the past quarter, the revenues grew by close to 14% sequentially. The company also reported record EBITDA and profits in FY26. To discuss this and more, we're joined by Anurag Chaudhary, the CMD of Himadri Specialty Chemicals on the show. Hi, Anurag. Good to see you win, and congratulations on a good showing in the past quarter and the year as well. Let's get a few details out of the way. I'm looking at the trajectory that you've laid out on your presentation. You're talking about higher amount of value-added products. So if you could give us a simple number as a percentage of the revenue mix, what is it? And where is that number headed, given that you've commissioned some capacities?
If you look at our numbers, there has been a stable growth in top line over the last 2-3 years, basically because we were focusing more on value-added products. And when you go for value-added products, what actually happens that the raw material becomes the finished product, and you go for more value to the same product. That's the reason the bottom line was growing, and the top line was growing in a lower percentage compared to bottom line. And today, if you look at our Q4 numbers on a consolidated basis, we have reported a growth of 14% in terms of top line growth also. So in terms of percentage, the value-added products are growing from, it was around 25-30% to 50% around.
All right. So currently it's around 25-30%. You're saying it goes to around the 50% odd mark. Is that correct?
Right.
All right. Now I want to ask you about this anode capacity, because the street gets very excited about these, these sort of businesses. And I think you've commissioned the 200 MT anode capacity. Could you tell us what is the revenue potential? How do you see this ramping up? And ultimately, where do you want to take this anode capacity to?
So anode has been something we have been talking about for last more than 10 years. lithium chemistry, we have been focusing for last 14 odd years and have invested a lot of money in terms of research and development in this product profile. And the unique thing, what we have been able to achieve now is a culmination of years of dedicated research and development and innovation mindset. As you know, research and development don't yield result in a year or two, but we kept working on it. And the unique proposition which Himadri brings to the table is a complete integration. So from raw material to finished product. So what we did, we made special quality, highly technical coal tar pitch converted into coke, and this coke into anode material. This unique value proposition no one has. So that is something on which the company has worked. And now with this commencement of production of anode material, it's the new beginning of a new era of growth for the company.
Okay, but this 200 MT can give you what kind of revenue, sir?
See, this 200 MT is just the beginning. Okay. The idea is to set up a huge capacity. This is the first step in the direction.
The targeted capacity on the anode side would be, say, in the next 2-3 years from here?
So we are planning on that, and I'll come up with full details on full planned capacity over the next 4-5 years, and the capex spread on that.
All right. You've added some capacity then on the other part of your business. So what utilization levels are you targeting on the new capacity addition for the specialty carbon black business?
So for the current year, we are targeting around 85 to 90% capacity utilization.
On the incremental capacity, right?
Incremental capacity, that's right.
So, all right. So if I look at it, in the last year, that is FY25, you did around 550 crores of profitability. And I recall you mentioning in your past con call as well that you want to see that double by FY28. So, currently it looks very expensive. Market cap 28,000 crores, and you're currently doing around 750 crores of profitability. However, the street is willing to look ahead. So by FY28, do you stick to that guidance that the net profit number actually will be more than 1,100 crores?
Definitely. And if you go by our track record, you can see we gave the same guidance for FY24 to FY27. And we achieved nearly that in 2 years.
Oh, that's encouraging.
Yes, I am very much optimistic and confident of achieving what we have guided.
All right. Okay. That's encouraging then to hear. What about Birla Tyres? How do you see that business scale up? And also profitability, when does that come about in Birla Tyres? What is the targeted number?
So if you look at the year FY26, this is a transitional year for Himadri and a landmark year also, where in the entire year, if you see, we debottled our core capacity from 500,000 to 600,000 tons, which result you will see in the current year. We expanded our specialty from 60,000 to 130,000. We introduced naphthalene ball. We commenced production of Birla tire, and that's ramping up on a monthly basis. And looking forward, you will see huge revenue coming in from Birla tires in terms of sales of OTR, OHT, and BS tires.
Okay. Since it's ramping up, sir, you want to give us a number? What is it doing currently in terms of a revenue or a utilization level at Birla Tyres? And where do you see that number headed to?
Last year, we did a top line of 187 crore from Birla, from tire business. In next 3 to 4 years' time, I expect this to cross 3,000 crores.
Wow. 3,000 crores. All right. Final question, sir. There's ongoing capex across carbon black, battery materials, downstream integration as well. The point is, currently your ROC is sitting above 30%. Over the next few years, with you scaling these businesses, do you think the ROC can continue to be maintained above this 30-35% odd mark?
See, I feel we are, for myself, the most important thing, dynamics, which I look when we invest in any business is ROC. And so we have a benchmark, internal benchmark of ROC, and we have to stay above it. And I'm fully confident that we'll be staying above 30% in next 2-3 years.
Okay, all right. It's a pleasure talking to you, sir. For the time being, the street likes what you've had to say. We're going to hold you to these numbers. FY28, you're going to be hitting around 1,100 crores of net profit. The ROC continues to hold above the 30% odd mark. And you're very bullish on a couple of these businesses, like the tire business and the anode capacity as well, will be hiked. Thanks a lot for joining in. Wishing you a good day ahead and a good financial year ahead as well. Okay, time for another earnings conversation then. Union Bank of India reported a 6.6% rise in profit, driven by lower operating expenses as well as provisions, while margins moderated by around 12 basis points and slippages rose. My colleague Ritu spoke to the management and started off by asking them about the NIM compression outlook and the sustainable margin level. Let's listen in to a slice of that conversation.
If we see, the circumstances which were prevailing that point of time, and the MPC as of now has continued with the stance. And going forward, keeping in the same scenario, we are very sure that this is almost like a bottomed out sort of, and we expect improvement in the NIM because we are already working on the various efficiency parameters. So going forward, we are very sure that we will be in a position to, defend it and improve it from this position.
Any particular level, sir, a NIM target that you've had?
NIM, actually, we are thinking around 2.7 up above that levels.
Okay. So let's also talk about that 700 crore standard asset provisioning that you made as a one-time measure in the fourth quarter. Now, last quarter, I recall you had told us that the ECL shortfall was about 4,200, 4,300 crore rupees. So if the ECL guidelines come through, this 700 crore will barely move the needle. So I wanted to understand the requirement for making this kind of a buffer. I mean, if you have to meet ECL requirements, do we expect provisions to remain high for the next few quarters? Or is this a cushion against any potential stress you're seeing building up in the system?
See, that is very clear then, when the counter-cyclical buffer also from the regulatory guidelines when it came. So general, the perception and the prudence is that whenever you are doing good, your asset quality is good, your efficiency is improving, your growth is also there. It is always better to keep aside something. So on that basis, if you see, we are dividend paying and dividend is increased, the profit is increased. If we come to SMA level, we are at the lowest levels. That is 3,833 crore. If we take more than 5 crores, SMA 0, 1 and 2, all the figures, all the three figures. Now, keeping that in view, our slippages are less. I think almost from around 4,500 crore, our recoveries are more than the slippages. The slippages from last year to this year is much less. That is around 4,000 crores. So keeping in view all those things, and if you see the quality, asset quality, 95% our corporate book is more than 25 crores, not only corporate, but more than 25 crores is above BBB and above. And if we take the retail, 680 and more than 680 is considered as prime, but we have taken internally 700, and if we take 700 and above, 99.8% is above this quality.
So to summarize, you're saying that there is no potential stress build-up you're seeing because of which you've made this additional provision. The only reason is to build a buffer for the later ECL requirements. But again, back to the question, the ECL requirement is far higher. 4,300 crore is the shortage you've spoken about. So do we expect, say, for the next 6-7 quarters, we will see a similarly high provision number from Union Bank?
No, it is not like that, because this time, if you see, this provision which we have made is not impacting the net profit or the capital. So actually we were comfortable on all the 3-4 counts and other efficiency parameters and business parameters. That is why it is just an initiation, it is a start to build up the buffer, and so that we can keep it. And any stakeholder, whether it is a regulatory or the government of India or any investor, and even the staff members. So strengthening the balance sheet is, I think, is resilience, and it is a prudence for any management and for any bank. So we have just kept it, and then there are guidelines. If suppose we talk about ECL, then certainly regulator, as per the draft and other things, it is already there, it can be spread out and also we will see that point of time. But at the same time, when we are discussing, West Asia crisis or this ECL and all, so just, it is for sure that this 700 is kept aside. So I think rather it can be looked that the bank has kept as a proactive prudential measure, as a forward-looking measure, that the amount is also good. So 700.
Got that, sir.
But at the same time, it has not impacted dividend. It has not impacted profitability. It has not impacted ROA.
Okay.
It has not impacted ROE. So in all the parameters, we are better. And then this is kept aside, I think, only as a forward-looking measure, forward-looking prudence, and strengthening the balance sheet and resilience, and giving a comfort to all the stakeholders that yes, we are there with
Got
this
that,
and
sir.
we are
Got
ready
that.
for anything which is going to come forward.
Sir, let's talk about your asset quality briefly. It's risen sequentially from about 1660 crores to more than 2,000 crores. I also see your SMA1 book has nearly doubled. So what led to the increase in slippages in this particular quarter? Where did that come from? And, when it comes to the West Asia affected sectors, your export-linked exposure, MSMEs, etc., are you expecting any kind of deterioration there? And if you could give us a guidance of what the credit cost for FY27 could look like from these low levels of 0.23% that you've been able to get to.
We have continued, if you see, we have continued with a very contained credit cost and slippages ratio. And we have tried to recover more. The recovery is much more than the slippages. And the asset quality on the book, whether on the SMA side. So your first question, that SMA 01, actually, we are in discussion very rigorously with all the people who are in the SMA 01 and 2. So basically, it is a movement from 2 to 1. So that is clearly one thing that is the reason you see SMA 1. If you see the last quarter, SMA 2, it was just, the swapping of the figures from SMA 2 to SMA 1. So there is again not an issue on that. Now, when you said that, there is a slightly increase, so there is a slight increase, but it is not anyway related to West Asia crisis or anything. Our exposure, to the I should say the institutional or a corporate is around 3,000 crore only. We are monitoring very rigorously on the inward remittances, on the import remittances, and we are also seeing whether it is same is hedged or not. We have also talked to the SMEs, and when we see there is an elongation of the goods that are coming, through the alternative routes. So these were the thing, and certainly the energy backed up sectors. Like which are in ceramics, Morbi, cement and all, which are not very big players, have seen certainly some sort of a stressed, working capital cycle. But then the regulator as well as the government of India has come forward, and if we see, we have received around 380 applications, and in this around 200 is already sanctioned, and we are moving ahead in that. If we take the trade relief measures from RBI, so there also, we have received application, we have all attended to, but then the many people are not coming. This also gives an indication that they are managing within themselves anyhow right now, but they're not resorting to. So as of now, this has come recently, but then we are in touch with all, and we have not as such seen any disruptive situation in this. So this year, this quarter also, in the earlier quarters, the slippages are just normal as usual it used to happen. But total, if you see, we are around 8,000 odd crores, and it is much less than the earlier year slippages of 12,000 odd crores.
So, sir, in just one word, credit cost guidance for FY27?
So generally, we are right now in the range of 0.22 and 25 levels and all.
Yeah.
But then, safer side, we say we will be below 1%.
Okay, all right. The management of Union Bank in conversation with Ritu after numbers and some outlook as well. Well, I think the other big story, of course, is politics, right? West Bengal and Tamil Nadu both have recorded their highest ever voter turnout. Tamil Nadu saw polling at 85%, while West Bengal touched a record 92.5% in the first phase of assembly elections. Sanjeev Srivastava, senior journalist and political analyst, is with us now. Sanjeev, I believe you're in Bengal?
Yes, last 6 days we have been here now.
Okay.
So we've traveled through the region where voting was yesterday.
Okay.
Now, right now I'm in
92%.
Kolkata.
I mean, that is mind-blowing.
Well, the number itself is mind-blowing, but if you try and put it in perspective, Prashant, it was 82% last time. And considering the fact that SIR has resulted in deletion of about 27, 28 lakh votes in all, so the base becomes lower. So from a lower denominator, it is not, if you see it from that angle, that less number of voters are there and the voting percentage is higher. So approximately, especially in Tamil Nadu, the numbers remain approximately the same as last time around, but the percentage has shot up. And I think the same story has played out in Bengal. And of course, those who have remained in the electoral list also seem to have come out in large numbers to ensure that they exercise their vote, and since they've retained their voting rights.
Yeah. So, what is...
To read much into the voting percentage, maybe missing out the true picture of what is happening on ground.
So, what is your assessment? You're a seasoned election analyst, and we've done this long enough, Sanjeev. So,
you again are making me stick my neck out, and it has its own hazards,
Yeah.
And not always one is right also. But what I think is the sense on the ground where voting was yesterday in West Bengal. So North Bengal has around 54 seats, and the BJP had its nose ahead even in 2021. So I think the BJP may gain a few more seats in North Bengal. In Central Bengal, which is Murshidabad, Malda, and those areas which are heavily Muslim populated and minority dominated districts, that's where the largest number of deletions have also happened. But despite the deletions, the number of Muslim voters remain very large. So I think the battle there is also the communists and the Congress has come into play with the TMC. I think in Central Bengal, the result will be more or less the same, maybe little more seats for BJP. And in Greater Kolkata or Calcutta Presidency, where there are 100 plus seats, 110 odd seats, where voting will be on 29 together with some tribal areas. That's where the TMC scored disproportionately well, if you may, last time, and they got 215 out of 294. I think the story remains more competitive here. It has become more competitive, but I don't think it would mean a very big gain for BJP in terms of seats. So likely that the TMC may still be coming down in numbers, but it's likely to have its nose ahead in the final outcome. Now, this is a very difficult election to call because the BJP has pulled out all stops. The TMC is totally rattled, fighting for its survival. But I don't get the sense on the ground that a large number of electorate is willing to swing towards BJP this time. They are doing their best in every sense. But whether they will be able to cross the ropes or win the election, I personally have doubts. It will be a close one, but TMC ahead.
294 total. अभी तो एक phase ही हुआ है, but 150 done, right? Approximately.
150 done, yes.
Total, how much? As you said, stick your neck out. What's the tally?
I think the TMC should get 150 plus easily. So it will be a large downward swing for them vis-a-vis 215 of last time.
Okay.
But, it's, in 6 days you can cover maybe 20 constituencies. I'll be foolhardy to say that I understand it all or my friends understand it all who are traveling with me. Yeah. But that's the overall sense one is getting, that people may still come back to TMC because they don't want to see, except for selected some sections, the BJP coming to power. There is huge misgovernance by TMC. People are genuinely unhappy. If the left was a real option, left and Congress were a combination and they had worked for a year or so, it would have been even a more interesting election. But as things stand, that's what my takeaway is.
Yeah. Yeah. Well, just quickly, that's Bengal. What about Tamil Nadu? Any thoughts?
Tamil Nadu, I think it's like the conventional wisdom and thinking in political circles it much will depend on actor Vijay and how many votes in terms of percentage votes he is able to get for his party and from where he takes those votes, from AIDMK or DMK. Having said that, it still looks that the ruling party may return to power. The DMK again has its chances. Their chances are much better.
Better. Got that. Sanjeev, we'll have you back. And I won't hold you to the numbers, numbers, but,
I dread it. I dread coming back this time.
So, I mean, whenever we, it is what it is, and it'll be what it'll be, and we'll, of course, track it with you when the results come. Thank you very much, Sanjeev.
Thank you for having me. Thank you.
We'll take a break. Manisha will be joining us with the focus on commodities on the other side. Stay tuned. Welcome back. Let's shift focus to the commodity space. Manisha is here with what she's tracking. Manisha, morning.
Morning, and thank you for that, Prashant. Well, I'm looking at the crude oil prices. It continues to be very, very volatile onto this one. We started before the West Asia conflict at $70. We've seen 120 on the higher side, a correction all the way up to 92, and we're back above $106 a barrel currently. So when you look at the overnight markets therein, we've gained up by 4%. This current week, the prices have gained up by an 18%. And for the year, that now adds up to nearly 74% of gains for the Brent crude oil prices as we see it. Well, there are a lot of headline statements coming in from the US and Iran, where US 1 has ordered the US Navy to spot and kill, shoot and kill vessels laying mines in the strait. There also have been various reports suggesting that the US forces boarded a supertanker carrying Iran oil in the Indian Ocean. There also is a truce between Israel and Lebanon that the markets are looking at that perhaps is going to be for the next 3 weeks there. In the meanwhile, Iran has also seized a vessel around Strait of Hormuz. So all of these statements, all of these events continue to support the crude oil prices therein. The U.S. military also has released a statement suggesting that the U.S. forces have redirected nearly 33 vessels till time since the blockade began therein. But take a look at the various statements that have been coming in from agencies, banks and brokerages as well. Vitol, for one, says that nearly 4 million barrels per day since the start of war is a loss that we are looking at in sense of demand, and supply loss stands at around 12 million barrels per day. Most of that, of course, coming in from Middle East. So that's the number that we are working with right now. And then there are various reports suggesting that 178 refineries, which account for, by the way, nearly 40% of world refining capacity, are affected because of Strait of Hormuz there. Also, 80 oil facilities have been damaged within West Asia. So all of that premium is what you are seeing into the prices right now. But even more important is the demand destruction. Various austerity measures is what we've seen from Asian governments come in. But this data comes in from EIA, which says that nearly 0.6 million barrels per day of a demand destruction is what they are working with. S&P Global Platts, pardon me, has put out a number at around 0.4 million barrels per day of demand destruction therein. This is a near-term price forecast really coming in from various banks, and this is only for second quarter. A long-term vision is something that most banks have continued to revise in. So Goldman Sachs talks about $90 a barrel of an average for the current quarter. You have EIA talking about an average of $95 a barrel. StoneX says that their base case scenario is anywhere between $88 to $110 a barrel. Depending on what they see in sense of news flow, the prices can move higher or lower. Morgan Stanley has put a forecast of $110 a barrel as an average for this current quarter. You have JP Morgan talking about $150 a barrel if this, what we are looking at, continues into the second half of 2026 as well. And that's exactly what Bank of America also says, that their near-term targets stand as it is, but $130 a barrel is what they're also not ruling out if there is a prolonged West Asia conflict coming into the markets, which could lead to further decline in supplies. And while it could damage demand as well, but at this point in time, supplies clearly is the headline.
All right, Manager, thank you very much for that. Supplies is a supply shock more than anything else showing up in prices. Well, 180 points lower. What is incredible is the open, right? I mean, absolutely strange open with the market on the Nifty, I think the open was higher today. The open was 24,100. I think, yeah, okay. So it was kind of flattish, and then the market started to dip. But lots of stocks, etc., started up, and they've all completely reversed as we've gone on. We'll take a quick commercial break here. We'll come back with our special segment. It's the economy. Latha in discussion with PIMCO's Greg Share now, on where crude prices are headed as the war drags on. Stay tuned.